Most traders believe they lose money because they cannot predict the market. That is rarely the real reason. A man can read the market correctly 6 times out of 10 and still end the year broke. Another can be wrong half the time and quietly build a fortune. Strange, isn't it? The public spends years searching for the perfect entry, the perfect indicator, the perfect news source. Yet the thing that usually ruins them happens after the entry, not before it. Position sizing. Not the glamorous part of trading. Not the story people tell at dinner. But it is the dividing line between survival and extinction. Let me ask you something. Have you ever noticed how a trader's confidence changes with size? A man enters one position small, and suddenly he thinks clearly. He waits. He observes. He accepts uncertainty. Then he doubles the size, triples it, and now every tick feels personal. Every candle looks like a threat. Every pullback feels permanent. What changed? The market did not change. The trader changed. That is the first lesson. Most trading mistakes are not analytical mistakes. They are emotional reactions caused by oversized positions. A trader who risks too much cannot think objectively. His judgment becomes distorted because his nervous system is involved. He is no longer reading the market. He is defending himself from fear, and fear has a peculiar effect on decision-making. It speeds up bad decisions and delays good ones. You see it every day. The oversized trader cuts winners too early because he is relieved to escape pressure. Then he holds losers too long because realizing the loss feels unbearable. One behavior creates small gains. The other creates catastrophic losses. The math becomes hopeless long before the trader understands why. And here is the dangerous part. The trader often blames strategy instead of size. He changes systems, changes indicators, changes markets. But the real problem follows him everywhere because he never solved the core issue. He was trading emotional size. Now think carefully about this. Why do inexperienced traders become obsessed with large position sizes? It is not greed alone. Greed is only the surface. Underneath it is impatience. They want the market to change their financial condition quickly. They want one trade to accomplish what only consistency can accomplish over time. But markets do not reward urgency. They punish it. A trader who needs immediate results becomes vulnerable to emotional extremes. He forces trades. He increases size after losses. He tries to recover quickly. Then the market begins controlling him indirectly through his own expectations. That is why disciplined sizing is not merely risk management. It is emotional management disguised as mathematics. The experienced operator understands something the beginner does not. Survival creates opportunity. If you survive long enough, you will eventually see extraordinary trades, clean trends, obvious imbalances, moments when the market practically announces its intention. But if you destroy your capital during ordinary periods, you will never be present for exceptional periods. This is why professionals think differently about capital. The amateur thinks, how much can I make? The professional asks, how much can I lose without damaging my judgment? Those are entirely different philosophies, and the difference reveals itself most clearly during losing streaks. Anyone can appear disciplined during winning periods. Success hides weaknesses. But what happens after 4 losses in a row? What happens when confidence begins to erode? Do you reduce size calmly? Or do you become aggressive because you feel pressure to recover? Be honest with yourself here. Some traders are not trying to trade well. They are trying to escape discomfort. That creates reckless behavior disguised as determination. A disciplined trader understands that size must fluctuate with conditions. Both market conditions and personal conditions. When the market becomes erratic, he reduces exposure. When his concentration weakens, he reduces exposure. When emotions become elevated, he reduces exposure. Why? Because consistency of mind matters more than consistency of aggression. Now here is something many traders misunderstand. Small size is not weakness. Small size creates clarity. When your position is manageable, you can observe the market honestly. You can let trades develop. You can sit through normal volatility without panicking. Patience becomes possible because fear is reduced. And patience in speculation is a tremendous advantage. Have you noticed how traders often increase size precisely when they should decrease it? After a series of wins, confidence expands. They begin feeling invincible. The market feels easier than it really is. So naturally, they start pressing harder. Then comes the inevitable trade that reminds them the market owes nobody mercy. This cycle repeats endlessly because human nature repeats endlessly. That is why position sizing must be rule-based before emotion arrives. Not during the trade, before the trade. A trader who improvises risk under emotional pressure will eventually sabotage himself. The mind becomes persuasive when money is involved. It can justify almost anything. This setup looks stronger. I'll make it back here. This one feels different. Feelings are unreliable risk managers. Rules are better. Now that does not mean every trade deserves identical size. Far from it. Strong opportunities exist. Weak opportunities exist. Market conditions shift. Volatility expands and contracts. But the skilled trader scales thoughtfully, not emotionally. He increases size gradually after evidence, not anticipation. That distinction matters enormously. The public tends to size based on hope. Professionals size based on demonstrated behavior. Suppose a trader normally risks 1% of capital per idea. He notices the market entering a highly directional environment. His setups are working repeatedly. Correlations are aligned. Momentum is clean. He may increase exposure carefully because conditions justify it. But notice what comes first. Evidence, not excitement. You can build an entire career on understanding that difference. And here is another point few discuss openly. Large position sizes create attachment. The bigger the trade, the harder it becomes to admit error. That attachment quietly corrupts decision-making. Suddenly the trader is searching for information that confirms his position rather than information that challenges it. He stops observing reality and starts protecting identity. This is how manageable losses become disasters. Not instantly. Gradually. First comes denial, then rationalization, then paralysis. All because the position was too large for emotional flexibility. A calm trader can exit quickly because his ego is not trapped inside the trade. He understands that being wrong is part of the profession. But oversized traders take losses personally. Every trade becomes a referendum on intelligence, discipline, even self-worth. That emotional burden is too heavy to carry consistently. So the question becomes, how should a trader think about size? Not as a tool for excitement, as a tool for endurance. Your first responsibility is not making money. It is maintaining the ability to think clearly tomorrow. Because once emotional stability disappears, analytical ability usually disappears with it. And this is where many traders become confused. They assume discipline means suppressing emotion entirely. Impossible. You are human. Fear and greed will appear whether you invite them or not. The real objective is different. You structure your position size so emotions remain small enough that reason can still operate. That is the practical purpose of discipline, not emotional perfection. Emotional containment. A trader who understands this stops measuring success trade by trade. He starts measuring it by quality of execution. Did he follow sizing rules? Did he remain composed? Did he preserve capital? Did he avoid emotional escalation? Because over time, those behaviors compound quietly. And compounding is subtle in the beginning, almost invisible. The disciplined trader often looks unimpressive early on. Small positions, controlled risk, limited excitement. Meanwhile, others appear to be making fortunes overnight. But watch closely what happens after enough time passes. The reckless trader experiences violent swings. Confidence rises and collapses repeatedly. 1 month of brilliance followed by 2 months of recovery. Emotionally exhausting. Financially unstable. The disciplined trader moves differently, slower perhaps, but steadier. His capital remains intact. His judgment improves because experience accumulates uninterrupted. He is still present after others disappear. And eventually, something interesting begins to happen. Because he survived long enough. Because he protected both capital and clarity. Because he learned to think independently under pressure. He starts recognizing moments when the market shifts from noise into opportunity. Most traders miss those moments because they are too damaged emotionally or financially by the time they arrive. Most traders believe their biggest enemy is the market. They blame volatility, manipulation, bad news, unexpected reversals. But if you watch traders long enough, you begin noticing something uncomfortable. The market usually does not destroy them suddenly. They destroy themselves through the size of their positions. A trader can handle uncertainty when the risk feels manageable. He can wait, he can think, he can observe price action without panic, but increase the size beyond his emotional tolerance, and everything changes. Suddenly every tick matters too much. Every pullback feels dangerous. Every candle becomes emotional. Have you ever noticed how calm a trader looks before entering a large position, and how different he becomes afterward? Before the trade, he sounds logical. He talks about probabilities, patience, and discipline. After the trade, he checks the chart every minute. He searches for reassurance. He reacts emotionally to small movements that normally would not matter. Why does this happen? Because oversized positions turn trading into emotional survival. The market itself has not changed. The trader's nervous system has. This is what many people fail to understand. Fear is not always caused by losing. Most fear comes from risking more than the mind can comfortably process. And once fear enters decision-making, judgment begins to weaken. The trader stops following the market objectively and starts reacting to internal pressure. That pressure creates predictable behavior. He cuts winning trades too early because he wants relief. He cannot tolerate watching profit fluctuate. At the same time, he holds losing trades too long because accepting the loss feels emotionally painful. So he delays the decision, hoping the market rescues him. Think about the damage this creates over time. Small profits, large losses, emotional exhaustion, loss of confidence. Then comes the dangerous part. The trader often thinks the strategy failed, so he changes indicators, changes timeframes, changes markets. But the same pattern follows him because the problem was never the setup. It was the emotional weight attached to the position size. The market punishes emotional size because emotional size destroys consistency, and consistency is impossible without emotional stability. Professional traders understand this deeply. They know the first goal is not making money quickly. The first goal is staying mentally clear enough to execute properly over long periods of time. That requires position sizes small enough to keep emotions under control. Notice something important here. Smaller size does not reduce ambition. It increases precision. When risk is controlled, patience becomes easier. The trader can let the market develop naturally instead of forcing outcomes. He no longer feels trapped inside every fluctuation. That freedom changes how he interprets information. A calm trader sees reality faster than a desperate trader. Now ask yourself this. Why do traders increase size aggressively after a few wins? Because confidence expands faster than discipline. Success creates the illusion of control. The trader begins feeling smarter than the market. So naturally, he starts risking more. Then the market shifts slightly, not dramatically, just enough to expose emotional weakness. And suddenly the same trader who felt invincible begins making irrational decisions. He revenge trades. He averages into losers. He abandons risk limits. Not because he lacks intelligence, but because oversized positions amplify emotion faster than logic can respond. That is why discipline in position sizing is not just mathematical. It is psychological protection. A trader who controls size controls behavior. And behavior is what ultimately determines survival. Most traders think bigger positions create bigger opportunities. On the surface, that sounds logical. More size means more profit potential. But the market has a way of exposing shallow logic, because while larger positions may increase potential reward, they also increase emotional noise. And once emotional noise becomes too loud, clear thinking disappears. Small positions do something most traders underestimate. They protect perception. A trader with manageable risk can actually observe what the market is doing instead of what he hopes it will do. That difference sounds minor until real money is involved. Then it becomes everything. Have you ever noticed how differently you interpret price movement depending on your position size? A small trade allows patience. You can watch the structure develop. You can wait for confirmation. You can accept temporary fluctuations without emotional panic. But once the position becomes too large, objectivity begins to collapse. Suddenly a normal pullback feels threatening. A delayed breakout feels suspicious. A red candle feels personal. The market has not changed. Your emotional attachment has. This is why small positions create clear thinking. They reduce emotional interference. They give the mind enough space to remain analytical under uncertainty. And trading is entirely a game of uncertainty. No trader truly knows what will happen next. The best traders simply manage probabilities better than others, but probability-based thinking becomes difficult when fear enters the process. Fear pushes the brain toward immediate protection instead of rational observation. That is why oversized traders constantly react instead of respond. They close trades too early because they feel uncomfortable. They move stop losses emotionally because they fear being wrong. They chase entries because they fear missing out. Everything becomes driven by emotional urgency rather than disciplined interpretation. Now think carefully about this. Why do some traders perform beautifully in simulation accounts or with small capital, then suddenly collapse when size increases? Their knowledge did not disappear. Their strategy did not suddenly stop working. The pressure changed, and pressure reveals whether a trader truly understands risk or merely understands theory. Small positions allow the trader to stay mentally flexible. Flexibility matters because markets constantly shift character. Sometimes momentum is clean. Sometimes conditions are choppy and deceptive. A trader must be able to adapt without emotional resistance. That adaptation becomes nearly impossible when the position feels financially overwhelming. The mind narrows under stress. Instead of observing multiple possibilities, the trader becomes attached to one outcome. He starts searching for confirmation rather than truth. And once that happens, decision-making quietly deteriorates. This is why experienced traders often appear calmer than beginners. It is not because they feel no emotion. It is because they understand how to size positions beneath emotional overload. They know that preserving clarity is more valuable than forcing large returns from random opportunities. A calm trader sees details others miss. He notices weakening momentum. He notices failed follow-through. He notices changes in volume behavior. These observations require emotional balance. Panic blinds perception. And here is something interesting. Small size also improves patience after entry. Most traders ruin good trades not because the setup was wrong, but because their position was too emotionally heavy to hold properly. They need immediate movement in their favor because the discomfort becomes unbearable. So they interfere. They exit too soon. They micromanage every candle. They transform short-term noise into major decisions. Small positions reduce this need for control. The trader becomes more willing to let probabilities unfold naturally. That patience often produces better results than aggressive prediction ever could. Because in trading, clarity is a hidden advantage. And small size protects clarity. Most traders enter the market focused entirely on profit. They think about freedom, fast growth, big winning trades. Very few think seriously about survival. And yet survival is the foundation beneath every long trading career. Without survival, skill becomes irrelevant. The market offers endless opportunities over time, but only to traders who remain financially and emotionally intact long enough to recognize them. That is the part beginners rarely understand. They approach trading as if every week is a final exam. They feel pressure to produce immediate results. That pressure pushes them toward excessive risk, emotional decisions, and eventually unnecessary damage. Have you noticed how traders behave when they believe they must make money quickly? They stop waiting for quality. They begin forcing trades. Every setup looks urgent. Every missed move feels painful. Patience disappears because survival is no longer the priority. Emotional relief becomes the priority. That is where destruction quietly begins. A trader who does not value survival will always take risks that exceed his emotional stability. He may experience temporary success. In fact, aggressive risk often creates exciting short-term results. But excitement and sustainability are not the same thing. The market has a brutal way of collecting payment for emotional impatience. One oversized trade, one stubborn loss, one emotional reaction after frustration. That is often enough to erase months of progress. And what makes this dangerous is that the trader usually believes the problem was bad luck. It rarely is. The deeper problem is a mindset that treats capital as ammunition instead of inventory. Professional traders think differently. They understand capital is not merely money, it is opportunity. Every dollar preserved gives them another chance to participate when conditions improve. Every unnecessary loss reduces future flexibility. This changes how disciplined traders approach risk. They do not ask, "How much can I make from this trade?" They ask, "How much damage can this trade realistically cause if I am wrong?" That shift sounds simple, but it completely changes behavior. Now the trader becomes selective. Now he respects uncertainty. Now he understands that preserving capital also preserves emotional confidence. And confidence matters more than most traders realize. A heavily damaged trader does not think clearly. After major losses, hesitation appears. Fear increases. Decision-making becomes inconsistent. The trader begins doubting valid opportunities because previous emotional pain still influences perception. This is why survival is psychological as much as financial. A trader who survives difficult periods calmly develops resilience. He learns how markets behave under different conditions. He gains experience without destroying his ability to continue. Over time, this accumulated experience becomes a hidden advantage. Because markets move in cycles, there are periods of confusion and periods of clarity. There are environments where almost nothing works, followed by environments where opportunity becomes obvious. Traders who survive long enough eventually recognize these shifts. But reckless traders never stay around long enough to benefit. They burn themselves out during ordinary periods while searching for extraordinary returns. Think about how often traders increase risk after losses. Why? Because they want recovery faster than reality allows. Instead of stabilizing emotionally, they become more aggressive, and aggression fueled by frustration rarely produces discipline. The market senses emotional urgency quickly. A desperate trader stops following structure. He abandons patience. He trades to escape pressure rather than interpret opportunity. At that point, survival disappears from his decision-making entirely. And once survival disappears, consistency usually disappears with it. The strongest traders are often the ones who look unimpressive in the beginning. Controlled risk, steady behavior, limited emotional swings, nothing dramatic. But they remain standing while others constantly restart. Most traders believe bad decisions come from lack of knowledge. They assume that if they study harder, find better indicators, or learn more strategies, their trading problems will disappear. But watch traders closely under pressure, and another truth becomes obvious. Judgment changes when position size becomes too large. A trader can analyze the market intelligently before entering a trade. He can identify risk clearly. He can explain probabilities calmly. But once the position exceeds his emotional comfort, his behavior starts shifting in subtle ways. And subtle distortions are dangerous because the trader rarely notices them while they are happening. Have you ever seen someone become emotionally attached to a trade almost immediately after entering? Before entry, they sounded flexible. After entry, they suddenly become certain. Every piece of information now supports their position. Opposing signals get ignored. Why? Because oversized trades create emotional investment beyond money. They create psychological attachment. The trader no longer wants objective truth. He wants emotional protection. This is how position size distorts judgment. The market itself remains neutral. Price continues moving according to supply, demand, liquidity, and sentiment. But the trader begins interpreting market behavior through emotional pressure instead of observation. A small pullback becomes manipulation. A failed breakout becomes temporary noise. A clear warning sign becomes just volatility. The bigger the position, the harder it becomes to think honestly. And honesty is everything in trading. You cannot adapt if you cannot see clearly. This is why oversized traders often hold losing positions far longer than planned. The problem is not always technical analysis. Deep down, they know the trade is weakening, but the emotional pain attached to accepting the loss becomes too heavy, so they delay action. First comes hope, then comes rationalization, then comes paralysis, all because the position size exceeded emotional tolerance. Now think carefully about this. Why do traders often perform better after reducing size following a major loss? It is not because the market suddenly became easier. It is because emotional pressure decreased enough for clear thinking to return. Clarity returns when survival no longer feels threatened. A manageable position allows the trader to remain flexible. He can change his mind without emotional collapse. He can exit quickly if conditions shift. He can reassess objectively because his identity is not trapped inside the trade. That flexibility disappears when too much money is involved. The mind narrows under stress. Instead of evaluating possibilities, it becomes obsessed with avoiding pain. And once pain avoidance becomes the dominant motive, trading quality deteriorates rapidly. This explains why some traders become impulsive after increasing size. They start chasing entries. They react emotionally to small price fluctuations. They overtrade because heightened pressure creates internal urgency. Oversized positions accelerate emotional behavior faster than logic can regulate it. And the dangerous part is that temporary success can reinforce this behavior. A trader who wins aggressively begins believing oversized risk is strength. Confidence expands beyond discipline. He starts thinking larger size means greater skill. Then eventually the market changes character. Conditions become less favorable. Volatility shifts. Timing weakens slightly. And now the same oversized exposure that once created excitement begins creating instability. This is where emotional decision-making becomes visible. The trader moves stop losses emotionally. He averages into losing positions. He searches for certainty where none exists. Not because he lacks intelligence, but because emotional pressure has corrupted perception. That is why disciplined traders protect judgment more carefully than profit. They understand that clear thinking is a competitive advantage. Once judgment becomes distorted, even strong strategies lose effectiveness. Because in speculation, the quality of thinking often matters more than the quality of prediction. And oversized positions quietly destroy the ability to think well. Most traders believe discipline is something they will find in the middle of a trade. They assume they will stay calm when pressure arrives. They tell themselves they will exit correctly, respect risk, and remain rational once real money is involved. But the market exposes one painful truth over and over again. Emotion is strongest after the trade begins. That is why risk rules must exist before emotion arrives. A trader without predefined rules becomes vulnerable to emotional improvisation, and emotional improvisation almost always sounds reasonable in the moment. That is what makes it dangerous. Have you ever noticed how persuasive your mind becomes when a trade starts moving against you? Before entry, the stop loss made perfect sense. You accepted the risk calmly, but once the position turns red, the internal conversation changes. Maybe the market just needs more room. This support still looks strong. It will probably reverse soon. What happened? The analysis changed because the emotion changed. This is why rules created during calm conditions are more trustworthy than decisions made under pressure. A calm mind evaluates probability. An emotional mind seeks relief, and relief is a terrible risk manager. Most catastrophic trading losses do not come from one bad setup. They come from broken discipline after the setup fails. The trader ignores the stop. Then he reduces position size emotionally instead of exiting properly. Then he adds to the loser because he wants recovery faster. One emotional decision creates another, and once the chain reaction begins, objectivity weakens quickly. This is why professional traders rely heavily on predefined structure. They decide position size before entry. They define invalidation points before entry. They know how much they are willing to lose before emotion becomes involved. Because once money starts fluctuating in real time, the brain changes priorities. Instead of focusing on execution, it begins focusing on emotional survival. Now think carefully about this. Why do traders often follow rules perfectly during simulation trading but struggle with real capital? The strategy itself did not change. The market did not change. Emotion entered the process. Real money activates fear, greed, impatience, and ego simultaneously. Without predefined rules, those emotions begin negotiating with logic. An emotion usually negotiates badly. A trader tells himself he will risk 1%. Then a setup feels stronger, so he risks more. He tells himself he will stop trading after 2 losses. Then frustration appears, and suddenly he wants revenge on the market. He promises himself patience. Then fear of missing out arrives and destroys timing. This is why discipline cannot depend on mood. Rules exist precisely because emotions fluctuate. Strong traders understand something many beginners resist accepting: consistency is built through structure, not motivation. Motivation changes daily. Confidence rises and falls. Emotional energy shifts constantly. But rules create stability when emotions become unreliable, and the market constantly tests emotional weakness. There will always be uncertainty. There will always be temptation to abandon structure during stressful moments. That temptation never fully disappears, even for experienced traders. The difference is that disciplined traders respect the danger of emotional decision-making. They understand that one impulsive action can undo weeks of progress. This is especially important during losing streaks,